Hey everyone, Paul here, and in this video I'm going to be covering HIMS. I'm going to be looking at an at a glance. We're going to be taking a look at the product breakdown, state of the health industry, share price trends, financials, and valuation. So that's all to come. I'm going to link to that. If you want to jump to one section, you can absolutely do that, but I'd appreciate if you would watch the whole video. I'd also appreciate it if you could subscribe if this video helps you and you want to see future stock analysis videos. But let's get into the analysis. So let's jump into the at a glance, and here I want to start with the strong subscriber unit economics, and this was called out in an investor presentation. But this is showing that if we look at the long-term value of their customer, the LTV, and we compare that to the customer acquisition cost, that CAC that we see, we're seeing this in the upper left hand here, and they're saying that their long-term value of the customer is 3 times greater than their customer acquisition cost. So again, that's a really strong metric to see. What we can also see is that their revenue growth has really been just really impressive, right? 128% CAGR, compound annual growth rate here. We look at from 2018, 2019, 2020, they went from 27 million to 83 million to 138 million. And they're projected by 2022, to be up over 200 million. So they're growing really strongly. Look at their telemedicine. They've had over 2 million consultations. They've seen a lot of strong growth there. And this was a company that started out more as a product company, so having some of the healthcare products available, and they've transitioned more into providing those products, but now also providing the telemedicine consultations as well, which has really been driving a lot of their strong growth. We can also see that a big part of this company is the fact that they've got this recurring revenue. So for a lot of their products, if you're going to sign up for a hair loss product or, a sexual health product or some of these things that they offer, a lot of these customers, 91% in fact, are, staying with those, subscriptions and the prescriptions and things of that nature, which is really good when you can get a company that can get that kind of recurring revenue. And that is in fact what's able to drive this 3x on their customer acquisition costs. Here we can see a breakdown again about that subscription versus the non-subscription. So they do have some wholesale business. They do have some online, purchases out there that are non-subscription based. That's only 2%. But again, the bulk of that being subscription based, which is great. But then when we actually break it down by product, we can see sexual health is the main focus there. And then the hair, dermatology, and other is about 35% of that. So between those two segments, that's really what's driving this. But by all means, the company is called out that they see a lot of areas that they can expand into. So this isn't their only scope. This is just what they've been able to use so far. This here kind of gets into a little motivation for the company. This is the purpose of why HIMS and why HERS, why this company exists, and I think why they're doing so well. But it's the acknowledgement that, and I think we all kind of know this on some level, that there's a lot wrong with healthcare as it currently exists, right? So it's expensive, it's inaccessible, inconvenient, all these things that they're calling out that, a lot of times if you want to schedule an appointment, you're going to be waiting an average of 24 days, right? So, so if you can't afford your deductible, maybe you're going to put that off, right? So what HIMS is trying to do is they're trying to be able to put together a product offering and connect with the customer in such a way where you're adding value, you have a good product, you have a good service, but it's also affordable. And clearly, again, they've shown that with the gross margins that they've been able to produce so far and the growth in their gross margins, which we're going to get into when we get into the financials here. But they're setting this up in such a way where it's good for the consumer, it's good for the company, and they've got a long runway for growth here. But this is really what's motivating it. And when we take a look at the share price performance here, HIMS has really been on a tear. We look at it in the past 6 months, just in terms of what the SPAC has been. It's up a ton. If we look at it, even from January 27th, from where it closed, it's up 50%. And sometimes when you see a stock that's ran that much, you might start to say to yourself, well, maybe I should wait on this. Maybe I should wait for a pullback and all of those things. But from my perspective, what I really want to do is I want to be able to put this in perspective and say, okay, if it's currently at this $18.99, what do I actually think it's worth? Because, if I actually think it's worth $30 and I'm still able to get it at $18.99, I don't care if it's ran up by 50% or 100% or 200%. I don't care what's happened to it in terms of the recent share price trend. What I care about is where it's going. And that's what I'm going to be taking a look at when we get into the valuation section. And I think there's something really interesting I can share with you. I'm pretty excited about what the valuation shapes up to be. Before we get into the valuation, though, let's take a quick look at the financials here. So we've been talking about this revenue growth going from that 26 million, the trailing 12 months, going up to over 130 million. And it just had really incredible growth. I mean, they grew, year over year from 18 to 19 by over 200%. Even in the trailing 12 months, they've grown by 60%. And company estimates, they're expected to grow still by about 30% for 2021 and 2022. But what's even more impressive, right, is that I've highlighted the fact that their gross profit percent has increased from 29% all the way up to 70%. And a part of that, again, is the fact that they're able to leverage that strong unit economics with their customer acquisition, the fact that they have that 91% recurring revenue, right? So that's part of what's really driving this gross profit percent increase, because they're really being able to grow from word of mouth and from growing a community, and there's some, cross-selling ability from the, telehealth visits with their products, and with the products to be able to sell the telehealth visits as well. So there's good synergy there. But they're expecting the gross margin to continue to grow all the way by 2022 to hit about 75%. Something to keep in mind is right now, though, they are actually, if you look at their operating income, they've actually lost money for the past, 3 years, and they did launch in 2017. But when we look at these trends and we say, okay, growing at the rate that they're able to grow at, they're going to start getting around a break-even point with their 2021 estimates. And by 2022, we could start talking about actually having some positive operating income for HIMS. What I think that happens is that a lot of times when you start talking about a company transitioning from losing money to making money, that becomes a catalyst for more publicity. You're going to see more articles about it, more people becoming aware of this company. And I think when that happens, again, that's just going to be another catalyst that could potentially move this stock higher. Finally, let's get into the valuation, because again, we talked about with a share price that, in the past couple of days, the stock has been up over 40%. It's been on a pretty big run, but where's it going? Like, what do I think it's worth? What makes sense based on the data? Well, again, with the current share price at $18.99, what we have to consider here is the market cap is a little shy of $500 million. So it's at $477 million, which is pretty small on the scale of things, okay? So, when we look at this, the fact that the market cap is so small is one of the reasons why this represents, an opportunity to grow even further. But when we look at, I'm going to start out here with the 2022 estimate for revenue. So the company is estimating that by 2022 that they're going to be up to 233 million. Now we've already seen that historically, they were, at first grew by, 200% by 60%. And even over the next couple years through 2022, they're expected to grow year over year revenue, by, mid 30%. So what I'm looking at here is saying that, okay, well, what if from 2022 to 2030, they're growing by 10% a year, which only gets them to $500 million in revenue by 2030. And when you consider the fact that this company isn't actually even tapped into the funnel from insurance yet, and that they're, working towards that, when you consider all the different product lines and ways that they can kind of branch into, I think that there's a ton of growth out there. So I think 10% in some ways is actually a pretty conservative approach here. And they're also currently trading at about 2 times sales. But I think that, when you look at if they're able to sustain a 10% growth rate over this time frame, I think that, certainly they would be in the conversation for having a premium price to sales, a projected price to sales multiple. So I'm going to say that by 2030 that, investors are going to be willing to pay 3 times sales, which with their sales being about 500 million, that would put their market cap at 1.5 billion. Now, the first scenario I'm going to be looking at with no dilution, and I'm going to say that if that happens, that by 2030, their share price would be worth about $60, which then discounted that back to today's dollars would be about 25. So again, when we look at the $18.99 compared to 25, that's certainly getting some good value. I know that, I've had some criticism out there from some people saying that I'm a little too conservative with my estimates. So even if you wanted to bump this up and say, well, what if it was going to be 4 times sales, right? Well, then all of a sudden you start to say that, well, hey, maybe they're worth about $34. And quite honestly, with all the excitement in the market today and the excitement around some of these, SPACs and things of that nature, it wouldn't surprise me at all if this is, a kind of company that follows a similar trajectory to what Fubo has done, honestly. It wouldn't surprise me at all to see this trading in the mid to high 30s sometime in the next 6 months. But for me, I'm not trying to, forecast the animal spirits of the market. What I'm trying to forecast is the actual value. So I am going to still put this down to 3 times sales. I'm going to be expecting this 10% growth rate here. I'm going to say that, hey, I think that they're going to be able to hit $500 million by 2030 in revenue. And so for me, being able to purchase this below $25 and even below $20 where you can buy it right now, I think that represents good value. It's something where I've actually added 220 shares to my portfolio with this. And, if I'm able to get it at a more attractive price, if it pulls back at all, that's something where I'll be looking at adding to that position. So that's the recap. That's everything, that I thought would be valuable to share with HIMS. I think it represents a good investment. As always, make sure that you're doing your own research. Make sure it's something that fits with your portfolio before deciding that you're going to put any money into this. That being said, thank you so much for watching. I'm looking forward to putting more videos like this together. So if you enjoyed this at all, it would help me out a lot if you could subscribe. And I will see you next video.